I mean, this really sort of ignited the trades, or has ignited the trades where financing was needed. Anything that where you had to borrow money, all of a sudden, like that all looks good here.
Yeah, it looks good right now as long as the economy is in like good footing. And, I'll just say this about the Russell 2000. I mean, it has rallied more than 20% off its lows in the last month and a half. It's still down 20% from its all-time highs made in Q4 of 2021. And it was one of the first sectors to turn when the Fed indicated that they were going to start raising interest rates. So, they led on the way down, and again, they're leading on the way up. But let's just see. To me, it looks like it's in a bit of an equilibrium. And again, it might be that rates have run too far to the downside in the near term, to Chris's point about what the weak dollar might ignite going forward. I mean, Jeffrey Gundlach, we were talking about it last night on the desk. I mean, he seems a little bit worried about, inflation picking back up. That being said, look at where crude oil is. Look at where nat gas is. If you think about, and I'm just going to bring this back to large caps, right, which are very exposed to the dollar and a lot of these input costs. When you have a dollar move the way it has in the last 2 days, and you were an analyst and you're trying to think about the economic landscape and the visibility the companies that you follow are in the new year, you say to yourself 2.5% in 2 days for a multinational, you know what I mean, that gets, say, more than half their sales outside of the U.S., and especially if some of these parts outside the U.S. are starting to inflect, let's say, before we are, at least that maybe that's what their stock market, well, that should buoy earnings. Okay, so like I get all that. Lower rates should buoy earnings. Right. So if you're looking, FactSet has, I think, expected 12% year-over-year earnings growth for 2024. They're expecting less than 1% earnings growth this year. They were up 4% last year. So let's just say that 12% is high, but with the dollar down and rates down and other input costs, maybe that's how you get with more cost cutting and the like. Maybe that's how a 19.5 multiple, if you look at the consensus, is about 245 for earnings next year with a 4,700 S&P. It's 19.5 times. It's 1 or 2 turns over the 10-year average or something like that. So I can see why people are saying maybe we're not that expensive, especially if you take out those top 10 names. Right. I'm not buying them here. I'm just telling that right now.